we are preparing for a slowdown in the economy. We've had a period of time in the markets where earnings for the second quarter are up about 6.5%. They've actually exceeded what we expected to occur. The markets have responded enthusiastically, with the S&P rallying from the bottom about 12.5%.
What's not to like about that level of rising profits for American companies? The problem is that's the level that's just going up right behind us. What will next year's EPS look like? And when you've risen and you've had profits rise so sharply, it's harder to grow them. It's going to be harder, again, in the face of tighter monetary policy.
The market, right, is looking right now at EPS, and it's all excited about the second quarter, right? But when the Fed raises rates, it's done two things. One is it has crushed housing. It has also driven up the cost of rental apartments, rental units everywhere, as people are not buying homes.
When we constrict housing overall by making it less affordable, and we start building less, and you can see again those supplies of unsold homes starting to pick up, well, then we start firing construction workers. Then we stop buying. And you can take a look at the price of lumber, which has collapsed. You stop buying those construction materials. And then we start losing, again, imports. We start reducing production of consumer goods. Those are the things that accumulate in the economy as you have tighter monetary policy.
There is a little bit of good news in the bed. Goods inflation is slowing sharply as a result of the fact that basically supplies have caught up with demand and then some.
So therefore, trade slows, production of consumer goods slows. But right now, we're still increasing the pace of consumer goods production. So again, this is pushing us to think that essentially the manufacturing sector will have a recession next year. In terms of hard landings, the good news is that the services sector has only just caught up to its level of demand and spending as where we were in late 2019. By 2024, services prices will also be diminishing.
All of this says we are preparing for a slowdown in the economy, which ultimately means that there will be lower earnings in that environment. So this whole thing explains why we're looking for companies with stable earnings and companies of high quality that have pricing power in an environment that we consider is not going to be treacherous. It's just going to be slowing materially from where it is today. We now have exposure to pharmaceuticals. We have exposure to areas of growth like cybersecurity that are well valued in portfolios. We have great exposure in the fixed income space. We are not investing in small and medium-sized stocks. We are not in European and Japanese bonds. We will take more risk in technology shares. We will take more risk in small and medium-sized stocks when we believe we are 3 to 6 months away from it all clear and actually have some understanding of what's going to take place.
The time is just not right for us to be taking more cyclical risk. We would actually want to see those leading indicators pick up again and get all that weakness out of the way before we really start to take a greater risk within the equities market.
So this is why asset allocation matters, why we are overweight bonds by 10%, why we are in these non-cyclical stocks that are part of our unstoppable trends. These are things that we actually go out and actively do. And what that does is it prevents us from losing a lot of money, right, when markets do very poorly, but it sets us up beautifully for what Stephen said, which is rotating our portfolios to growth, rotating our portfolios when the leading indicators turn positive.